How do you know when the markets are going to crash next? Well, there's 5 signs that give us those answers. And while it's true that no one can predict exactly when it will happen, if you're watching these 5 indicators, you're going to have a good idea of when the markets are about to crash next. And these 5 indicators have been right over the last several crashes. So let's see what they're saying right now. So stay tuned. All right, welcome back. So we are talking about this pending market crash. Everyone's calling for doom and gloom, and when the markets are going to crash in 2020, or maybe they're going to go longer, and you're hearing all this conflicting information. And the truth is that nobody knows. We don't know when the markets will crash, but what we do know is that what goes up must come down. All right, we do know that. If you look over 100 years or hundreds of years of market cycles, you can see they go up and they go down. They go up and they go down. We know that, right? And so what we do know is that we are in the longest upcycle, a bull market in history. We're in the longest one. And what comes after an up market? A down market. So we do know that, but when? That is the question. Now, timing it is tough. It's not just tough, it's impossible. Nobody can predict when the markets will crash. So if anyone's telling you it's going to happen in 2 months or 6 months or 12 months or 18 months, they don't know. It could be tomorrow. It could be 2 years from now. We don't know that, all right? And the only way to know when the market top is in or the market bottom is in is when you're looking backwards. Predicting it is impossible. Now, we have the central banks, and their entire job is to prevent market crashes. Now, of course, the market crashed in 2008, 2009. They jumped in. They've pumped over $4 trillion into the markets to get it back up from 2009. Here we are 10 years later, almost going on 11 years later, and the markets are frothy. The markets are at an all-time high, and we're seeing this final market rally. Now, I made a video about a year ago. I'm going to link to it up here, where I talked about that the market was going to have this rally, and everybody thought that the markets were done after the end of last year, about a year ago, and the markets were going to crash. And I said, no, I don't think so. I think we're going to see this one last rally, because markets like this, the longest bull market in history, they don't end with a whimper. They end with a bang. That means like a big explosion, a big drop. And that's because the markets are the most frothy at the top. The most frothy, the most action happens at the top. So if we look at just like the last 2 big crashes, if we look at the dot-com crash in the late 1990s, in the last 18 months, we saw the market go up over 200%. And it went up over 100%, doubled in just the last couple of months before the big crash. In cryptocurrencies in 2017, we saw something very similar. And one thing we do know when we study these markets is that we can see that the blow off top, this very last piece, even though it goes up crazy, parabolic, it's very turbulent at the top. So you need to be prepared for volatility. We know that markets don't go up or down in a straight line. They go up and pull back, up and pull back. And because parabolic moves move much faster, they move faster up, but they also pull back down even harder. So we know it's going to be turbulent. The final stages of the dot-com boom, we saw the NASDAQ fall 5 times more than 10%, which is huge in a market like that. In the crypto boom, we saw it drop about 5 times, about 30%, right? The market's smaller, it moves much more, moves much faster. And so the blow off top, while it's our biggest opportunity to make a lot of money, it's also very turbulent, and we have to be prepared for that. And we know that we're in the final stages, and the final stages of the market are the largest and the fastest, where we get the most growth. But they're also dangerous because we know there's a crash coming, but we don't know when. So although we can't predict if it's in 2 months, 6 months, 12 months, what we can do is we can watch the signs, and the signs are going to give us clues on when that's happening. It's like if you got directions to go somewhere in your car, and they just said, hey, when you get to this mile marker, turn here. When you see the billboard with this thing, turn here. When you see that old mailbox, turn here, right? So you don't know how long it's going to take you to get there, but you know, as you're seeing these signs starting to happen, you're getting closer and closer and closer. When you see that final sign, you know it's there. And that's kind of what we're doing with the markets. I don't know if it's 2 months, 6 months, 12 months. It could be 3 years for all we know, but we have signs. So let's look at some of those. So first of all, we do know that the 3 major U.S. indexes have hit all new all-time highs. So the markets are still running higher. And so the market long-term indicators, we have long-term and short-term, the long-term vital signs are still looking good, right? We know that there's serious trouble ahead, but right now they're looking good. The bull market is still running. The bulls are getting old, they're getting tired, but they're not dead yet, all right? But there's 5 indicators, like I told you, that we're going to look at, and these are more shorter term indicators, and they're not flashing yet, but we want to keep an eye on these, all right? So the 5 indicators we're using to track the market's overall health, they're just not flashing. The last time they all flashed together was during the 2000 peak before the 2001 crash and the 2007 peak before the 2008 crash. So we're waiting to see what's going to happen with these indicators. But like I said, we have to know that there's going to be more volatility. There's going to be a deep correction. History tells us that, right? But we want to look at the short-term indicators versus the long-term. So the long-term indicators, they remain healthy. Like I said, the bulls are still running. They're getting tired. But it's the short-term indicators that are starting to look like there could be trouble. And so an example of a short-term indicator is sentiment. So sentiment measures how investors are feeling. And right now it's telling us that investors are starting to get complacent, meaning they're just expecting it to go on longer and longer and longer. Now, one of the indicators we look at is the CBOE put-call ratio. And what the put-call ratio does is it measures how many put options, which are bearish, that means that people are expecting the market to drop. It compares that versus how many call options, which is bullish. And so we want to look at the amount of bulls versus bears in the market. And so this is a contrarian indicator. So if everybody's bearish, then we think maybe we should be bullish. And if everybody's bullish, we want to be bearish, right? So we want to be contrarian to that right now. And we look at this indicator and we can see where everybody's betting. And right now, we're seeing the ratio hit the lowest levels since January of 2018. And back then, in 2018, in less than 2 weeks, it happened right before the S&P 500 plunged more than that 10% drop. And so last time we saw this, it equaled the drop in the market. We're seeing it set up again. Again, that's a short-term indicator. Another thing that we look at, another one of the indicators is market sentiment, right? That's how are people feeling about the market. And there's a few places that I like to look for sentiment. One of them is a research company that I follow. It's called the Investors Intelligence, and they report through their own proprietary measure. They measure like newsletter writers. So there's all these financial analysts writing newsletters, and they look at how these newsletter writers are. And right now, their sentiment, how these newsletter writers are feeling, is about 57% bullish right now. So again, everyone's bullish. The newsletter writers are bullish. And according to the firm, to the Investors Intelligence, they say that any reading above 55% suggests a short-term peak is forming. And so we're over that. We're over 55%. And just like that 10-day put-call ratio that we mentioned above, similar extremes preceded both of these corrections that we've seen so far, right? So we want to be careful. It seems like investors are getting too bullish. We also have another indicator. It's called the short volatility trade, and it's starting to get very popular. Traders are starting to bet that the stock market volatility is going to remain really low. So we have this COT report, Commitments of Traders report, and the speculators were net short, right? And an all-time record of over 200,000 of these future contracts this month. And so again, similar extremes precede the broad market correction. So that means we want to start paying attention, be cautious. Other indicators that we're looking at, CCN News Network, they have what they call their fear and greed index. And the fear and greed index has suddenly surged higher, right? So again, another indicator. We also look at Stansberry Research, they're a newsletter writer. They have a complacency indicator. They have a track record for like 25 years. They've been tracking this, and their complacency score has been spot on. As a matter of fact, it's called 9 of the last 11 broad markets. And so they're predicting a decline of about 10% or more. And so we're starting to see these short-term indicators. Now, none of this means there's a reason to sell right now. Right? Again, we have long-term indicators, we have short-term indicators. So none of them are saying to sell right now. So don't turn bearish, don't sell all your stocks, don't get out of the market. We don't want to do that because the last bit of the market has the most room to run. Remember, in the NASDAQ in the late 90s, it went up 200% in the last 18 months. In the last couple months, it went up 100%, doubled. Could have doubled your money. So you want to stay in it. The long-term indicators say that this bull market still has further to run, but we know it's going to be turbulent. So look at any corrections in the couple of weeks ahead as potentially chances to get back into the market, right? Those are going to be the opportunities to buy the dips, right? Now, if you've been following my advice or advice of some other people that are giving good advice anyway, hopefully you're practicing proper asset allocation, proper position sizing. You're already holding some extra cash. You've got money into gold and precious metals. Maybe you've put out a couple short trades, right? If you've done all that, then you can just sit tight, right? Sit tight, take advantage of the gains, watch the indicators as they come about, be ready, but don't do anything right now. If you haven't done stuff like that, if you haven't diversified your allocations, if you haven't done some shorts, haven't bought some gold, haven't prepared some cash, then you need to, all right? You need to, because we're in dangerous times. The long-term indicators look good. The short-term indicators are starting to look bad. We know there's trouble on the horizon, and we just don't know when, so we want to be prepared. You need a plan. If you don't have a plan, get one. Find one. I have a four-pillar blueprint guide. You can download it for free. It's in the description down below, and it can help you figure out the plan for you. And again, it's my gift to you for free, so check that out. And that's it. Just keep your eyes open. It's just like traveling on the road. You need to be paying attention to the sign. You wouldn't be traveling somewhere, driving a car, if you had your eyes closed. And you can't be investing in this market with your eyes closed either. So pay attention to the sign. Does that make sense? Give me a thumbs up if you like this video. If you don't like the video, give me a thumbs down. Let me know. Either way, I want to hear your comments down below. I love to have a conversation with each and every one of you down in the comments. And that's it. To your success. I'm out.